what you see, okay, is the expansion of the portfolios, okay, in terms of the number of securities inside, okay. So previously I talked about 3 different stock portfolio. Here I'm talking about n different stocks portfolio, okay. Many different risky stocks, okay. We can imagine that, right? We can really form it, okay. And here it is based on U.S. stocks, right? ExxonMobil, General Electric, McDonald's, and Merck, and all these things, right? And then what you can see is that the efficient frontier, okay, it will be expanded like this, the red curve over there, red curve, right? Will be bigger than any 2 combinations of, the combinations of 2 different stocks, right? Or 3 different stocks. Efficiency, what do you mean? Well, for a given level of risk, you achieve the best or highest expected return, okay? For example, over here, this portfolio will be more efficient than any portfolio in the same risk level over here, over there, right? For the same given level of risk, you are achieving the best return, okay? So that's what we call efficient frontier, right? Now, that's fun. Is there any more extension that we can talk about? Well, this is based on your risky asset, not only stocks, okay, but also it could be real estate, 강남 부동산 kind of things, or your crude oil, right? Or precious metals like gold, silver, or any kind of things, right? Uranium, I don't know. And then any kind of commodities like rice, wheat, corn, all these kind of things, okay? Now, those are, risky assets. By forming portfolio including all those things, you can achieve some efficient frontier like this red line, okay, curved ones, okay, all risky securities. But that's one part of our investment story, okay. Always you allocate your asset into risky assets and risk-free asset, the different kind of asset, just like what Keynes said to you, John Maynard Keynes, right? Risk-free asset, U.S. Treasury, okay, or 국고채 in Korean terminology, right? That kind of things. Well, by definition, that kind of risk-free asset will be pointed on a vertical line like this, y-axis. I'm going to call it RF because this is risk-free return, okay, RF, right? And then this RF point is the case when 100% of your money is thrown into or invested in U.S. Treasury. No risk, no fun. Very boring portfolio, okay? Why is it 0%? Because it is a guaranteed return, okay? Guaranteed return, okay? For sure you will get your expected return at the point of your investment, okay? This is typically what your grandpa will form in their portfolios, okay? For you, you may be more risk-seeking, and then you want to, invest more in the risky asset, right? But at the same time, you want to achieve efficient level, right? For that part, right, you want some combination, okay? Or combination of risk-free asset and risky asset. That risky asset wanted to be on somewhere on the efficient frontier, okay? But the thing is, your expected return of your portfolio, let's say it, over here will be a linear combination of your expected return on risk-free asset and 1 minus W of, I will call it RM, Okay, market portfolio, I would say, market portfolio, right? That market portfolio has to be on the efficient frontier. Could be anywhere, but once you fix your risk-free asset, risk-free return, you can think about a straight line relation because your expected return of your portfolio should be a linear combination, straight line combination between risk-free return and the market portfolio returns, right? Has to be straight line relation, right? So, what should be the market portfolio? Where should the market portfolio be forming? Okay, that's this guy. Okay, the tangent point. Okay, tangent point, because a part of your asset should always be in your risk-free asset, and then if you draw something like this, right, going under this point, right, if it is not tangent, you will say, oh, no, there is some efficiency that I can achieve by, how do you say, tilting up, and then there is always a better efficient portfolio above there. So how can you achieve the most efficient portfolio? Well, by forming a portfolio that is tangent on this point like this. And then you can think about this straight line going on, right? This straight line going on. Over here versus there, right? Point A versus point B. Which one is more efficient? Given that they are in the same risk level, B is more efficient. You can see that, right? So that's why, okay? The market portfolio will be there as a tangent point. The tangent point of your straight line. The straight line is called capital market line, and this market portfolio should be also tangent to this efficient frontier. And capital market line, we are going to talk about it a little later in the next slide. Okay, and then let's get to this portfolio over here. Let's say B. Okay, B. Well, how is it formed? Okay, what is it described? How is it described? Okay, well, we can think about it as a portfolio whose weight W is given on risk-free asset, and then 1 minus W on market portfolio, risky asset. Okay, over here like this, right? So linear combination like this. So inside interval, okay, W, 1 minus W holds like that. Quite intuitive, right? Can we form a portfolio on this extrapolated straight line? Okay, for example, over here, right? What? Is it possible? And the answer is yes. And the answer is yes. How? How? Okay, you may wonder. Well, this one is very, very overweighting on market portfolio. Okay, market portfolio, and then you can think of this as risk-free borrowing. Okay, you borrow your money at risk-free rate, and then whole amount is invested in market portfolio, right? This is something we call it leveraged position. Okay, leveraged position. For that leveraged position, what you can see, well, this is efficient. Okay, you can achieve your targeted return, targeted expected return with the best efficiency. Okay, which means for a given level of risk, you're achieving highest expected return by borrowing risk-free. Can we expect to have more higher expected return? Yes, of course, by going to the extreme. Okay, but in that case, notice that you are taking huge amount of risk like this. Okay, leveraged portfolio. Okay, you can think about it as some leveraged ETF kind of situation. Okay, as you do your virtual investments, right? Some of the instrument is called a leveraged Kospi index. What is that? That's this kind of situation. Investing with borrowed money, which is going to be, achieving higher expected return, but the cost is that the drawback is that you are taking excessive risk. Okay, very, very much. So that's risk-free borrowing and leveraged position on the market portfolio. And the same framework happens, explains that. Okay, the mathematical formula will be the same. Simply 1 minus W will be greater than 1. Okay, and then W will be minus in that sense, right? So negative W, okay, which means risk-free borrowing, right? So that's basically one thing I have to tell you. Move on to the next. Yes. Abracadabra, yes. Now, capital market line, okay? CML. I'm going to test you in the exam, CML. And later on, you will see SML, right? SSSN, SNM, right? SML line will be there for you, but CML is a nice contrast. So I'm going to ask you there, right? CML shows the linear relation between total risk of the perfectly diversified portfolio and the expected return. We're introducing risk-free asset. And the formula will like this, okay, look like this. Expected return of your portfolio will be risk-free return plus this expected return of your market portfolio minus risk-free return divided by the standard deviation of return on your market portfolio, which is market portfolio risk, times the risk of your portfolio. Okay, risk of your portfolio. Okay. Two-fund theorem. Investors split their money and put one into risk-free asset and the other into market portfolio. This is exactly what I told you. Okay, Keynes rule. A part of your asset investment has to go into your risk-free asset, and the other part goes into risky asset, right? So two-fund theorem. Okay, a part of it goes there, the other part goes there. And you may wonder, what is that ugly term over there, over here? This one, ugly, okay? This one is whatever you have on your x-axis, okay? This is x in your high school math, x, okay? But this is y, right? But this one seems like ugly to be a slope term somehow, but it is a slope term, right? This guy, slope term. Rise over run kind of things. This is something called Sharpe ratio, okay? Isn't it? S-H-A-R-P, sharp, razor sharp. No, this is Mr. Sharpe ratio, okay? It's last name of the Nobel Prize laureate in Stanford University, William Sharpe, right? And he invented this idea, okay? And then got Nobel Prize, right? Good. What is the intuition over there, right? Well, this is the excess return that you can get per unit of risk that you take. Again, okay? Excess return, what do you mean? Well, expected return of your market portfolio in excess of risk-free return, right? This is how much excess return that you can get, right? By taking 1 unit of total risk, 1 unit of total risk, okay? Total risk of your market portfolio, by the way. So any portfolio strategy, okay? Any portfolio strategy that you form, how much efficient is it, okay? You can tell it by Sharpe ratio, okay? Your portfolio strategy always give you some Sharpe ratio figure. The thing is, you want to achieve efficiency so that you want to achieve higher excess return for each unit of risk that you take. So higher Sharpe ratio rules, okay? That's the intuition there. Now, move on to the next slide. Hello, yeah. Limiting case, the market portfolio, the big assumptions, and the follow-up is like this. Assuming diversification costs nothing in terms of transaction costs and etc., etc., and that all assets can be traded. The limit of diversification is to hold a market portfolio, a portfolio of every single asset in the economy in proportion to its market value. This portfolio is called a market portfolio. And the consequence is that individual investors will adjust for risk by adjusting their allocation to this market portfolio and the riskless asset, such as T-bill rate, right? So what's the idea over there in pictorial sense, right? Getting back to our diagram before, wait, where are they? Right, over here. For an individual investor like you and me, okay, to be an efficient investor, okay, efficiently diversified portfolio investors, what can you do, right? Well, the thing you can do is forming a portfolio on this line, on this yellow capital market line somehow, okay? For example, over here, right? Or over there. That means a part of your asset into US Treasury or risk-free asset, the other part into market portfolio. Good luck, market portfolio, Andy Kim. Form market portfolio with your small bit of asset, your money, right? 100만 won. Can I hold like 2,000 different stocks in Korea? Okay. Should I buy and sell one stock of one share of 2,000 different companies? I don't even remember who they are, right? I can maybe remember 5 different stocks, but not more, okay? Monkey kind of, we all have some limitation in our cognitive abilities, right? So what do I do? How do I form market portfolio holding all different assets, all different securities there? Well, don't worry. You have index fund, okay? KOSPI index or KOSDAQ index kind of things, right? That index ETF takes care for you, right? The index fund, those fund, the index fund hold that specified number of stocks, the number of companies in their portfolio for you. So that by investing in that KOSPI index or S&P 500 index, it's equivalent for me, just like as if I am investing in those 500 different stocks or all the stocks in the market. Okay, so index fund is convenient tool for you to be on that capital market line or achieve some efficiency over there. Okay, so let's see. Your preferred risk level, if it is no risk, okay, grandpa, right, grandma, no risk please, because I want some fixed income, right? Just more risk, heart attack. No. So in that case, 100% on your T-bills, right? You're tolerant about some risk, well, 50-50, 50% in T-bills and the 50% on the market portfolio. A little more risk, maybe 25 on the T-bills and the 75 on market portfolio. Even more risk, 100% in market portfolio or leveraged position, as I said before, right? Borrow money risk-free and then invest in market portfolio. In reality, of course, you cannot borrow risk-free. That is a problem. Okay, so that could be another complication, but I'm not going to ask you about that situation, right? In theory, if you can borrow risk-free sometimes, you can take leveraged position. For market portfolio, okay, how much of return premium should we expect, okay, is a very important question for market portfolio. because this class is about the risk premium, okay, market risk premium. How much of a premium should we expect is a very big issue. That is called the equity risk premium. Okay, the equity risk premium. We call it RM minus RF in the formula. The idea is that let's think about how much the marginal investors in the market would like to get above risk-free return for a risky investment in a well-diversified market portfolio. Moreover, it should be forward-looking as we go into the future. What do you mean forward-looking versus backward-looking? Backward-looking is strictly based on history, okay? And then strictly based on history. And then if you use these backward-looking numbers, you are assuming future will be the same as the history, okay? But forward-looking means something more advanced, okay? More advanced, up to date, and then reflecting the today's market's investors' risk aversion, right? The question is, can we observe the true market risk premium, okay? Can we observe the true market risk premium? The answer is, again, no. The answer to most of my question is no, okay? I don't know if you can apply it and get some maximum return by using it in your final exam or midterm exam, but most of the time the answer is no. Now, risk premium, true risk premium, you cannot observe it. If you can observe it, great. Then why are you here, man? You should be in the Wall Street. The answer is no. Just like true value, okay? By the way, it should be moving. Come on. Yes. Right. Now, okay, the animation works. Yes. Now what? Just like the true value of a firm is not observable, true market value, market risk premium is not observable to our eyes, right? Now what? We have to estimate it, okay? Don't give up, okay? The key point is don't give up and then try to estimate it. That's finance is about, right? Estimation is a statistical way of getting to some unobservable true number called parameter, right? In statistical jargon. Then how? We have two approaches. One is historical equity risk premium. The other is implied risk premium. Okay, fine. Historical risk premium, what is that? Well, look back in history, look at the data, and figure out the average of RM minus RF, the return on your market portfolio, supposedly market portfolio, minus the return on risk-free asset, okay? Historically, there must have been some gap, right? So what's the average of it? We're going to take it as risk premium going into the future as well. Then hope and pray that RM minus RF will be the same in the future. Okay, good luck. The historical premium that stocks have historically earned over riskless securities, we have two different forms, arithmetic average and geometric average, right? Arithmetic average is what you learned in your the statistics, right? Take the average, divide by the number of observations, right? Whatever, observations and values you got. The values you get is RM minus RF, return on your market portfolio minus the return on your risk-free asset, time point by time point. And then you have the observation number there, divided, right? Okay, take the average, that's it. Geometric average is different, okay? Here, you don't need all intermittent observations. All you need is the beginning point and ending point values and take the geometric average of it. So for market return, you take the geometric average, 기하평균생 in Korean terminology. And risk-free return, you also get the geometric average of it. Remember, price at the time point of big T, this is today's price, let's say, should be initial investment, P0, times 1 plus r to the power of t, okay, to the power of t, which is compounding, right? Compounding interest kind of idea going on. Compounding, 복리계산 kind of things. 이자가 이자를 벌어요, or kind of interest on interest kind of things, or return on return, and 배보다 배꼽이 커지는 kind of situation going on there, right? So when you assume buying the market portfolio at time t0 and hold it until big T, this is going to be what's happening. So your geometric average return, if you do the math, right, will be P big T, a piece of big T divided by P sub 0, the whole thing to the power of 1 over big T, okay, minus 1. Okay, don't forget to subtract 1 over there because it's going to be, you always have 1 when you're doing this math over there, so subtract 1. Anyway, so what is important is this is the tth square root of this ugly term over here, okay? What's the idea? What's the idea? Again, you're holding, okay, once you invest in a certain, the market portfolio in time 0, you hold it until big T time, okay? Don't sell it or buying again, right? Okay, just hold it until the end. And then you will get end point price and beginning point price. Figure out what's the geometric growth rate that justifies this return, the growth, right? That's what's going on in this geometric average idea. Analogously, you can think about putting your money in risk-free asset on T0 and hold it until the end of the period, big T. So bond price of big T should be equal to your initial investment in B0 multiplied by 1 plus RF to the power RFGA, geometric average. This is not the power of GA, but this geometric average risk-free, okay, return, okay, to the power of big T, right, to the power of big T. So what should be your geometric average return on your risk-free asset? That should be b to the power of b sub big T divided by b sub 0, the whole thing to the power of 1 over big T minus 1. That should be it. Okay, now you got two geometric averages. The only thing you need to do is do the subtraction like this to get to the geometric average market risk premium historical basis. Quite complicated explanation, but you know, the whole idea is about holding until the end of the period. Okay, this should be, you know, just like compounded average return kind of compounding interest kind of idea should be holding over there. Okay, now everyone uses historical average premium, but practitioners never seem to agree on the premium. It is sensitive to how far back in history you go, right? 30 years or 100 years, 50 years, we don't know. Whether you use T-bill rate or T-bond rate. T-bill, what is that? As opposed to T-bond. Well, T-bill is short-term U.S. Treasury bond. Okay, short-term, by that 1 month or 2 months or 6 months or 3 months, okay, or 1 year, okay. T-bond is more long-term maturity, like 10 years plus, right? 30 years kind of things, right? Which one should you take? Well, it really depends on the investment horizon that you think about, okay? If you are value investors and then taking, you know, 8 years or 10 years investment horizon, okay? Just like Warren Buffett, or just like what so many people claim these days, as if they are value investors, 가치 투자자, okay? Not 가치 투자자, which is like together investment, but the value investment. Then you have to choose T-bond rate over there. You have to be consistent with your story over there, okay? If your investment horizon is just 1 month or 1 week or day trading, T-bill, okay, don't go for T-bond in that case. You have to be consistent. That consistency idea always holds you. Whether you use geometric or arithmetic averages, people differ, okay? So there is no one straight answer, okay? That is a hard part and fun part as well in valuation. Now, okay, historical risk premium for the US, United States looks like this. Arithmetic average or geometric average, depending on where you want to go, okay? Yeah, what determines whether you should choose geometric average as opposed to arithmetic average? Well, largely this is a preference, but if you insist on the idea that once you invest in a security and you never sell that stock until the end of your investment horizon, then geometric average idea will be more consistent with your story. But if you're more likely to trade intermittently, then arithmetic average may be more relevant for you. Okay, and then for each cases, right, you have two different subcases: stocks returns or market returns minus T-bills versus market returns minus T-bond returns, right? As I said before, bill or bond, right? Depending on your investment horizon. And then what you see on the vertical axis is the historical period, okay? 1928 to 2018, right? Almost like 91 years, right? 91 years. Or some people go to shorter history, like 1969 to 2018, and what's that? Some people even go even shorter, like 10 years, right? 10 years. And then based on that, they get the market risk premium, historical risk premium. And then what you see on every other line, the red colored ones are standard errors, right? In geometric average, you have only 2 data points, so that there is no concept applicable about standard errors, right? This is just mathematically computed. The arithmetic averages, this is really purely statistical exercise, so that you need a lot of data, you're estimating it, and then how accurate is that, right? How accurate is your average figure that you get, okay? How accurate is it compared to the unobservable parameter, okay? How accurate is it? Well, the accuracy is told by this standard error. You want smaller standard error to be more accurate estimate, right? So that's the idea. The interesting thing is, if you look at these standard errors, right? You see standard error gets bigger as you shrink down the observation period, or as you increase the number of, the standard error increases as the number of observations decreases. There's inverse relation going on, right? What's the intuition there? Well, how sure would you be, okay, about the true market risk premium, okay, based on what you observe in the data, okay? The less number of data that you got and take the average of it, you will be less sure about the estimate being equal to the true parameter. The more, on the other hand, the more observations that you have, big data, okay, then you are more sure, more certain that your average figure or the parameter estimate that you got is really, really close or equal to the parameter, unobservable, okay, thing, okay? So that's the idea. If you go back 10 years, well, you only see your 10 years history. Whereas right now, what we have is not explained by that. We did not have this kind of things before. So let's go back in more history, okay? And these days, a lot of people are, writing their blogs. Not only me, right? But many people write blogs about stock performance and is it a good time to invest or not? Blah blah blah. A lot of arguments go on. And then some people, okay, look back in history, like, and then say, well, 10 years ago, we had 9/11 attack, right? So based on what happened in 9/11, this Corona-19 virus impact will be this and that. Well, to me, it's like, that's just a 20 years ago thing, okay? Is that long enough of history that you're caring about? Don't we have to go back farther in history? We never had this kind of things in the first place, by the way. But this magnitude itself, is it comparable to terrorist attack? Shouldn't we go back further? Oil shock, right? For that idea, you may want to go back until 1969 or at least cover 1970s, right? But is it similar to oil shock kind of things? Well, perhaps not, right? Oil shock was not affecting that much about the travel industry or the oil industry, including education industry. Come on. The schools never stopped in oil shock, right? And then that makes us go back to Great Depression era, 1930s, and then going to 1928 for some purpose, right? So that's longest possible that you can go with some second-hand data or secondary data available, right? But some people like me, we argue that, Great Depression is not enough, right? These kind of things never preceded before, right? So unfortunately, it's not covered by the data. So historical risk premium may not work, okay, at all, right? That's my kind of pessimist view, right? Nouriel Rubini kind of guys, right? May argue this way. Anyway, so that's the idea over there. Another thing that you can check is that this stock minus T-bond, the inverse relation between the standard error, or the accuracy, I should say, accuracy and the data point, the number of observations that you get, okay? The inverse relation is more dramatic over there. Now, that's that. Good. If you choose to use historical premiums in the thick box, what does the data say? Well, your estimate of market risk premium is 7.93% based on 90 years data. But are you sure that the true market risk premium will be really 7.9%? Looking into the future, okay, is an important question. 7.93%, that's this guy, right? Are you sure? Going into the future, market risk premium will always be 7.93% or 8% going into the future, right? The thing is, people or the students have been memorizing this market risk premium too much, like a robot. Okay, market risk premium, RM minus RF, RM minus RF, RM minus RF, chicken, RM minus RF, RM minus RF. So much so that they forget about the intuition. Okay, what's the intuition there? Market risk premium, okay, is about the risk aversion. Okay, market risk premium is a function of risk aversion. I'm going to ask you this question in your final exam and midterm exam 2 times, right? By the way, risk aversion. Why? The people when they are afraid to take risk, they want to have more premium, market risk premium, okay? Get compensated more if I should take any risk. The same unit of risk that I take, I want more premium, okay? If you don't give me, I'm so afraid that I'm going to put my money into US Treasury only. This is flight for quality, flight for safe asset. It happens, okay? So, market risk premium is a direct function of risk aversion. So if you assume 7.93% of risk premium going into the future, you are essentially saying risk aversion will be the same as the risk aversion happened in over the last 100 years. And thinking about today's situation, is that something happened in what is this situation that we are experiencing commonly shared across 100 years, right? Okay. Is it something we experienced before? The answer is not really, okay? We are going into uncharted area, right? Very, very risky situation. So many people will be spooked, okay? So the risk premium should be higher, okay? Higher, right? That's something we have to keep in mind. Now, the answer is no. It is just an estimate with some errors, right? Always we have to recognize it. It is an estimate with some errors. So now what? Okay, now what? Is a question. How can we reduce the errors in our estimation for market risk premium? Let's say the standard deviation of this market RM minus RF or risk premium over the past 90 years is 20%. The standard error is 2.1% if you do the math like this. Standard error is like your standard deviation divided by the square root of the number of observations, right? So basically that's it. Remember in your statistics 101, 95 confidence band of your parameter estimate should be what? X bar plus minus 1.96 times standard error. So notice that X bar in this case, RM minus RF, right? X bar, or I should say RM minus RF bar, right, is 7.93%. So with 95% confidence, you can claim that the true market risk premium would fall into the band of 3.81% up to 12.05%, which is the result of these computations, right? And you see how accurate is this? 8% difference, okay? This is so noisy. This is so noisy, okay? Even though you are claiming, you're saying that 7.91%, 93% risk premium, there's still an error bound like that, 8% bound, okay? So less reliable. We have to be careful about this, right? There's a lot of noise going on. Okay, that's the whole message. Solution, go back as far back as you can. The estimate of market risk premium comes with a standard error, okay? The measure of noisiness. This is the measure of noisiness of your estimate. The smaller standard error, the better precision you get, okay? Now, some of you may question, okay, 7.93% seems like very noisy, okay? And then compared to what we experience these days, this is very spooky and scary market. The risk premium should be higher. Higher risk premium? Okay, well, you have 13% risk premium over here. Okay? So, why don't we choose to go back just 10 years in history? Okay? Well, that makes sense that makes sense only because the number itself, X bar, is close to what we feel, right, these days. But how noisy is it is another important question, right? What is the confidence band? 95% confidence band using this 10-year history. Okay, I want you to figure it out yourself, right? Using the same math. And then what's the band, the size of the band, right? Figure it out and see if it is any more accurate or precise than this guy. Okay, that's something you have to figure out. So that's that. Be consistent in your use of the risk-free rate. And since we argued for long-term bond rates, the premium should be the 1 year should be the 1 over T bonds, and use the geometric risk premium. It is closer to how investors think about risk premiums over longer periods, buy and hold return. But again, this is not a perfect candidate either. Nothing is perfect in this valuation world. Nothing is perfect in finance world. Accounting, you have some perfect answers. Good luck with that. We are not accounting guys. Proud to be non-accounting guys, by the way. We live with these errors and estimation errors. Okay. The question is whether this estimation error is within the bound of tolerance that we can accept. Okay. Okay. Now, so that's the thing. Okay. Geometric premium. We don't have the concept of standard error here. Okay. So there is a drawback with this geometric average kind of idea. And some more problems using historical premium is this. One problem with this is something called survivorship bias. I guess by now you guys are familiar with this survivorship bias concept, right? Because this is from your freshman years, you must have learned big data or fourth industrial revolution kind of things, or heard about some machine learning kind of things, and then what's the problem with this working with data kind of things, right? So survivorship bias, what is it? Well, using historical data from US equity markets or whatever country's equity markets over 20th century does create a sampling bias. What do you mean? Okay, what do you mean? The US actually, after all, the US economy and equity markets were among the most successful or luckiest of the global economies that you could have invested in early in the century. Okay, if you are making some statistical inference by focusing on successful guys, survivors only, okay, you will be hugely misled. For example, this kind of thing is, every now and then you see certain news article like this. Oh, here is a common habit among billionaires, right? For example, the first class airline, okay, the stewardesses of or steward of first class airlines, right? They report to the newspaper and say what? Oh, as we worked and served those clients or customers in the taking first class of my or Korean Airlines or Asiana Airlines or China Airlines, whatever, okay? We found some common features, okay, among these guys, and we believe this makes them successful, okay? For example, I don't know, they're good at shaking hands, for example, or they are very kind, right? Is that a success factor? So that if you're good at shaking hands, you will be billionaire? Or does that mean that you will be billionaire if you be kind to anybody all the time? Okay, that's survivorship bias, right? There can be equally unsuccessful guys who were still good at handshaking, or who are really kind to all the people they meet, right? We don't But the thing is, we don't observe, okay, those stewardesses or stewards in the first class cabins. They had less chance of observing those unsuccessful guys, right? So making your inference based on this limited sample who survived a certain criteria will bias your conclusions so much so that it will be useless. Of course, in the when that kind of story shows up in the news media, it's naturally attention drawing for everybody. Oh, first class customers, clients, right? I'm kind of interesting, right? Because everybody wants to be there, right? Somehow. But the inference they make in the newspaper, bullshit, right? Good to great kind of things, right? Here are the 5 habits of successful company CEOs. Don't believe that hype, right? You know what? Those successful guys has a habit of drinking coffee when they are doing presentation like Andy does. Everybody does drink coffee in a certain sense, right? But that's the thing. So U.S. stock market, in what sense is it lucky? Well, 200 years ago, the biggest stock market was London, and then 300 years ago it was perhaps Austria or the Habsburg Empire, right? Wien stock market was there, right? 400 years ago, Netherlands, right? Netherlands stock market. And if you take the average of the performance of this Netherlands stock market or Austrian stock market over their history of 400 years or 300 years, the market index return may not be as good as the market return of US, okay, in the over their own respective sample period, okay, because those empires experienced shrinkage of their economy. Of course, the empire fell down, okay. The US was only going up over the last 100 years, right? So maybe we are looking at only the lucky guys, okay? And that is why, the lucky guys performance, lucky market performance, of course, the return on the market will be bigger than the return on risk-free asset, okay, in that sense. Shrinking economy, the other way around, market performance will be miserable, minus, so much so that risk-free performance will be better than market performance. Negative market premium. But that market premium, historical market premium, does that make sense? No, never. Okay? Only in the data you can observe negative observation, negative in what's that? Negative values of market performance minus risk-free performance. But that does not help you in using into the forward-looking sense, going into the future. Is the market premium going to be negative? Okay? No. What you observe using the failed empire's returns, right, will be just a historical observation. Okay? This is just a realization. Okay? Realization happened to be negative. That does not mean that going into the future, risky assets will always have negative return. Should have that does not mean that the investors in the market will demand smaller expected return than risk-free investment. Always, the investors will demand higher return than risk-free assets as long as they are taking some risk. Okay, they will not say, I am happy to have negative return compared to U.S. Treasury. No. Okay, so that is my message here, right? Plus, that's the country by country comparison. Plus, within U.S., right, what is the survivorship bias that is prominent over there? Is that even among thousands of U.S. securities, U.S. companies, right, at any given moment, there are 6,000 or 6,000 companies or more in the U.S. stock market. S&P 500, okay, this is the most typical market index that we take to compute the market index return or market risk premium. And these 500 companies are the most successful companies in the US market. Okay, so what is the bias over there? Survivorship bias, right? Who survived to be the most successful 500? There are a lot of companies who went bankrupt, right? Enron 20 years ago, they had like what? Flash bankruptcy. And General Electric, Edison company, right? Edison, the light bulb, bling, bling, right? This company was the biggest company 100 years ago, 10 years ago, right? But a couple of years ago, it was going down, has been going down, right? By going down, they went out of the stock market index. The unfortunate thing is this S&P 500 index does not trace GE's poor performance afterwards, right? So in case this S&P 500 index captures those failure guys later on, then we may have less survivorship bias. But by design, S&P 500 index is supposed to suffer from this kind of survivorship bias.